Wouldn't it be great if you could put less than 20% down on a home loan, avoid monthly mortgage insurance, and allow the lender to pay it for you? Well, it doesn't work quite like that, but we're talking about lender-paid mortgage insurance today. My name is Scott Wynn, and I am a licensed mortgage advisor with the Wynn and Egan team at Citywide Home Loans. Would you like to know the best way to avoid monthly mortgage insurance? Well, here it is. It's to give this video a thumbs up. By doing that, you'll get no monthly mortgage insurance on any future mortgage you ever do. Kidding, of course. But if you find the video helpful, certainly appreciate a thumbs up. Before I can explain how lender-paid mortgage insurance works and whether or not it's the best option for you, we need to understand how interest rates work. See, when a lender quotes you an interest rate, what they're quoting you is a par interest rate. And the reason for that is because each interest rate has a price associated with it. Well, a par rate is an interest rate that has a zero cost and a zero credit. It's on par. But if you increase the interest rate, what ends up happening is the cost of the interest rate goes down or negative, providing a credit that can be used to offset costs at the time of closing. The exact opposite is true if you reduce the interest rate. The lower your interest rate, the higher the cost is, and that's generally what's referred to as discount points or paying points to buy down your interest rate. Here's a sample rate sheet. Now, this is just a snapshot. This is not to provide accurate, up-to-date information about interest rates in any way, shape, or form, but rather just to explain how rates work. So if we look at the sample rate sheet, what you can see here is that 2.875% is the closest rate to the par rate, that or 2.75%. So as you can see, a 2.75% would cost 0.238%, while 2.875% rate would provide a credit of 0.351% of the loan amount. With that understood, now let's talk about how mortgage insurance works. Basically, mortgage insurance is an insurance policy that protects the lender in the case that you default. If that were to happen, there's costs that are incurred by the lender, and that's where the mortgage insurance helps to cover those costs. The cost of the mortgage insurance increases as the risk does. Well, as you put less money down, the risk increases, and so therefore the mortgage insurance cost increases along with it. The more you put down, the lower the risk and the lower the cost. So putting all this together, we can start talking about lender-paid mortgage insurance. Now, one thing I want to make sure is clear is that lender-paid mortgage insurance is only available on conventional loans. It is not available on FHA or USDA financing, and of course with VA there's no monthly mortgage insurance, so lender-paid mortgage insurance doesn't apply there at all. So lender-paid mortgage insurance is only available on conventional loans. So the way lender-paid mortgage insurance works is we basically front-load the cost of the monthly mortgage insurance. So rather than paying it monthly, you pay a one lump sum at the time of closing. But rather than you paying it, we ask the lender to pay for it. Well, how does the lender pay for it? By increasing the interest rate to get that credit back that we talked about related to rates that can then be used to pay for the one-time lump sum cost of the lender-paid mortgage insurance. So here's a sample mortgage insurance rate card. What this shows you is the loan to value, or in terms of down payment, we're talking about 97% LTV being a 3% down payment. We're going to assume just for our sample illustration here that we're going to do a 10% down payment or a 90% loan to value. I'm also going to assume that we have a credit score in the range of 720 to 739. So if we do that, what we see here is that the resulting cost of the lender-paid mortgage insurance would be 2.5% of the loan amount. Here's that same sample rate sheet that we looked at a little bit earlier, this time highlighting what the interest rate would be with the lender-paid mortgage insurance. So if you remember, we are looking at either 2.75 or 2.875 being the closest to the par rate, meaning as close to a zero cost or credit as possible. However, if we want to cover the cost of the lender-paid mortgage insurance, what you can see here is that we need to be able to cover that 2.5% in cost that we looked at for the mortgage insurance, which means that we would result in a 3.5% interest rate on the mortgage instead of the, let's say, 2.875 rate up here. This then eliminates monthly mortgage insurance from your monthly payment, but incurs a slightly higher monthly payment in terms of principal and interest because your interest rate is a little bit higher. Overall, however, the monthly payment is lower in comparison to the principal interest plus monthly mortgage insurance that you would have as an alternative. Now, whether or not this makes sense for you depends on how long you're going to continue to own the home. And here's why. With conventional mortgage insurance, it drops off at the point that you hit a 78% balance in comparison to the price of the home. So as an example, if you purchased it for $100,000, once your loan balance reaches $78,000, mortgage insurance automatically drops off. So if you went with a monthly mortgage insurance option, it would generally take somewhere between 11 and 14 years for that mortgage insurance to drop off. Now, it varies depending upon the interest rate you have and the loan balance and such, but again, generally somewhere in the 11 to 14 year time frame. With lender paid mortgage insurance, there's no mortgage insurance to drop off because you've already front loaded the payment and paid it at the time of closing through the increased interest rate. So I put together just a quick, simple spreadsheet to show you what the calculations look like and to determine at what point in time does lender paid mortgage insurance become better than monthly mortgage insurance or vice versa. So what I've done here is I've said we're going to have a purchase price of $400,000 with 10% down, which would result in a $360,000 loan amount. With the monthly mortgage insurance option, we'll be able to obtain that lower interest rate of 2.875, which is a principal interest payment of $1493.61. And then the mortgage insurance per the mortgage insurance rate card for monthly mortgage insurance in a situation for 10% down and a 720 credit score was 0.46%, which is $138 per month in mortgage insurance. So those two combined come to a total payment of $1631.61. So now if we compare that to the lender paid mortgage insurance option, same $400,000 purchase price, $360 loan amount, we're going to go with the higher interest rate this time to be able to cover that mortgage insurance at the 3.5 rate, which is a principal interest of $1656. No mortgage insurance, so of course no monthly mortgage insurance cost, is a payment of $1,616.56. So in this case, the lender paid mortgage insurance option is actually less expensive by $15.05. So now what we need to determine is at what point does lender paid mortgage insurance no longer benefit you in comparison to the long-term financial impact. The way we do that is to identify at what point will this monthly mortgage insurance drop off. Well, the drop off point is $312,000, which is 78% of this $400,000, which would occur at month 70. And so over those 70 months at $138 a month, we will have incurred $1,052.92 in a higher payment, which is basically taking 70 months times the $15.05 excess that we'd be paying for the monthly mortgage insurance option in comparison to the lender paid mortgage insurance option. So over those 70 months, you will have paid $1,052.92 more to obtain the monthly mortgage insurance. So then what we need to do is we need to determine at what point do we break even. Well, the break even point is determined by taking the difference between where your payment would be after the mortgage insurance drops off, which is that $1,493, comparing it to the $1,616, and then dividing this by that amount, which basically says that it's another 9 months past the point that the mortgage insurance drops off that you'll recoup all of the cost that you incurred through the higher monthly payment going with the monthly mortgage insurance. So in this case, the break-even point is 79 months in this hypothetical sample scenario for you, which means that the lender-paid mortgage insurance option is better for the first 79 months, but if you think you're going to live there longer than 79 months, the monthly mortgage insurance is better. So what this means is that the lender-paid mortgage insurance option is going to be the better option in the short term. That's because the principal and interest payment with the lender-paid mortgage insurance is lower than the principal and interest and mortgage insurance option with the monthly mortgage insurance. The monthly mortgage insurance option is better in the long run because what ends up happening is, yes, you pay a little bit higher to begin with, but it eventually drops off, reducing your payment even lower than what the lender-paid principal and interest payment would be because of the higher interest rate you had to get in order to avoid the mortgage insurance. So ultimately, it comes down to a mathematical calculation based on your anticipated time frame that you're going to continue to own the home. The lender-paid mortgage insurance option is going to be better for those looking to own the home for less than probably around 10 years. Now, there's a lot that goes into determining whether or not lender-paid mortgage insurance is going to be the better option, including whether or not you're going to prepay on the mortgage, whether you're going to turn the property into a rental property and maintain the existing mortgage for a longer period of time. Lots of factors. My best suggestion would be to talk to a mortgage lender. The mortgage lender can help you in calculating at what point does the monthly mortgage insurance option outweigh the lender-paid mortgage insurance option. They can also look at different calculations depending upon how fast you plan to prepay your mortgage and so on. So there you go, lender-paid mortgage insurance. It comes down to how long do you expect to own the home and then just running some quick math to determine whether or not lender-paid mortgage insurance option is your best bet or monthly mortgage insurance is the way to go.